Marginal tax rates. You hear that term all the time, but what do we mean? I mean, why can't people just tell me roughly what amount of tax we'll be paying if I make a certain amount of money? What's the big deal? Well, it's that it is a big deal. So understanding the type of tax system we have in Canada is going to help you better understand your potential tax liability. And that'll help you make better decisions on how and when you conduct your business, decision around how much more you want to earn, given the energy you may have to expel to earn that extra money, and then give a chunk of it to the government. I'm going to take you through a bunch of stuff here that I think will be enlightening for you. But first, if after you've watched this, you've found it helpful, please like and comment. This will help me get this stuff out to more small business owners. Also, make sure you're subscribed and notified. And if you're not a Swain client, book a call. I'd like to do something about that. So what kind of tax system do we have in Canada? When you Google it, you're going to get a bunch of very similar definitions, but here's an excerpt from the one I like the most. A progressive tax system takes a larger percentage of income from high income groups than from low income groups. In other words, the more you make, the higher the percentage of tax you're going to pay, and vice versa. So accountants then describe the tax burden for folks in these different groups as the marginal tax rate. So what does marginal tax mean? It means the tax rate I'll pay on each additional $1 I earn over and above those tax brackets. You see, we all pay the same rates on income earned at the different levels, or what accountants call tax brackets. Now, there's lots of exceptions where folks in lower income brackets might be entitled to tax credits that wouldn't be available to higher income bracket earners. Or there may be credits available to groups such as disabled, seniors, folks earning pensions, or dividend income, employees, just to name a few, which have nothing to do with the earnings levels. But the point is, before any of these tax credits are applied, we all pay the same amount of tax at each level of income. But the rate goes up each time we hit another tax bracket. And that's the concept of marginal tax rates, or the tax burden on each additional $1 income earned at each bracket level. So for the most part, the more income I earn, the more proportionate share of taxes I'm going to pay, like it or lump it. So what are these brackets? Well, I want this video to stay relevant over the next several years, so I'm going to try to accomplish that by explaining that brackets sort of slowly change throughout the years, but generally not much from year to year. And it's not out of the ordinary for them to not change for a few years. But for today, I'll just give you an example so you get an idea what I'm talking about here. You're going to need to talk to an accountant if you want the current brackets, or you can actually just Google tax tips, marginal tax brackets, and pick the province you live in. So the marginal brackets on the regular income, like not dividends and capital gains, but like regular income like salary and interest, in my home province of Nova Scotia goes like this: 0 to 25K, 25K to 29.5K, 29.5K to 53.5K, and so on, ending in the highest bracket of everything over 235.6K. So the percentage marginal rates range from 23.79% all the way up to 54%. Now, the effective rates, meaning the actual total taxes within each bracket, like not the marginal, like for, that extra dollar thing, but the actual taxes within that bracket will be quite a bit lower. And although the higher your income, the more the marginal rate of tax will approach the actual amount of tax. And if you were to graph the two on an XY axis, I'm starting to sound like a nerd here, but at least you know I'm the real deal. But why is knowing these tax brackets and the resulting taxes useful to know? Well, if you're watching this video, chances are you're a small business owner. Small business owners that choose to operate under a limited company have some flexibility in the amount of money they take from their operating companies. And this in turn allows your accountant to plan or effectively utilize the benefits of lower brackets in years where we didn't necessarily need to withdraw monies from our corporations to fund the actual expenses of living. In a nutshell, we, the accountants, can kind of look at some scenarios and timing of when to book withdrawals, not necessarily actual withdrawals, to kind of spread incomes amongst lower tax brackets throughout a longer than 1 year time frame. And this is a big piece of how accountants will do planning to minimize tax. So let me give you the simplest of examples to illustrate what I'm talking about here. So say I have a company that made money, and taking withdrawals from this company would be the only source of income I have. Now, let's say I won enough money at the casino to fund the cost of my living expenses for a year. And hopefully you know that casino winnings are actually not taxable in Canada. Now, there really would be no reason for me to actually take any money out of my company because I don't need it. For example, at the time I did this video, if I had declared an 18K dividend, I would pay next to no tax. So wouldn't I be crazy to, at the very least, declare that? Not actually pay, unless I wanted to, an 18K dividend. If I didn't actually pay it, I just get a credit to my shareholder account, and that could be withdrawn at any time in the future tax-free. I might even decide that I don't mind paying a little bit of tax just to take advantage of the low brackets. You see how this works? Now, I hear folks in my town say this all the time. It's not worth me going out and doing that overtime shift because the government's going to take it all anyway. No, this is fundamentally not true. This is a myth that kind of enter popular thinking amongst folks that maybe don't deal with accounts regularly. But as I've explained, the journey to the highest tax bracket is a long one. Even if you're making over 235K, you're going to be left almost half of the income in your pocket. Now, if you do make over 235K, and let's face it, most of us don't, right? But if you did, like maybe you're an MD or you're presented with an opportunity to work some extra shifts at the hospital. Maybe you might ask yourself, is the extra shift really worth it? And yeah, I totally get that thinking, but that doctor would still be economically better off for taking that shift. It just might not be worth it to them. But the vast majority of us working more in that 25K to 100K bell curve are going to be much better off taking the extra shift. So, don't buy into this common thinking. Making more money is going to make you benefit more. And I'm not just talking about money here, because you might have many other reasons to not want to go to work extra, and that's okay. But I wouldn't use the extra taxes as the reason, or I'm going to call shenanigans on you. Look, that's tax brackets in a nutshell. Now you can take this info and go to a party and sound really cool. Okay, go to work and make some money.